Hello, everybody. Sorry for the slight delay here. We had some technical difficulties. At any rate, thank you very much for joining me for tonight. Another Browns win, which is always a good way to start the week. We're 8-3, 8 wins in a season for the first time since 2007. So that's encouraging. So I hope everybody had a great Thanksgiving break if you were here in the U.S. and had a great weekend if you're elsewhere around the world. Let's jump right in here. A couple things. First off, from Jeff, the US dollar breaking down despite a backup in rates and the lack of US stimulus. That shouldn't be happening. And that was something I tweeted earlier this week. And metals are also falling, equities are rising. And so Jeff just asked, hey, can you elaborate further? And sure, the regime we've been in since at least March, probably before, has been that either not enough dollar liquidity is good for the dollar. And so lack of stimulus would be good for the dollar. And we've had lack of stimulus, but it's not been good for the dollar. We've also had any time that you have not enough dollar liquidity, it's actually been good for U.S. Bonds. In other words, yields down. But now we're seeing yields up. And so that's a bit of a change as well. And those relationships that have been in place, like I said, since at least March and really through end of 2018, so almost 2 years, those relationships are not holding. As you noted, the precious metals are falling as well. Oil commodities are up, and so to me, it's all indicative of a narrative that we're going to get a normalization of growth with the new vaccines that are out. And I've quite frankly been surprised how quickly the narrative has shifted from no stimulus to party on Wayne, party on Garth, everything's back to normal again. I can understand why. I think the wish is the father of the thought on some level. But that's in terms of the dynamic that I'm watching, in terms of just watching this relationship break down, that we've been in place for the last couple of years, where lack of enough dollar liquidity, lack of stimulus is drives yields down and drives the dollar up. And now we're seeing a lack of stimulus driving, and we're seeing the dollar respond down and yields up. So clearly there's some growth being discounted there. Why do I scratch my head a little bit with it? And that ties into a question from CS, which is, Luke, you mentioned that the U.S. has a huge debt rollover in the next year, but why does it matter if all U.S. government debts and spending can be monetized by the Fed via too big to fail banks? And that ties into this point of scratching my head a little bit that the commodities are running, and precious metals aren't rallying. Is that we had a tweet, probably one of my most liked tweets ever last week, but it just showed that over 20% of the U.S. Treasuries outstanding are set to mature in under 12 months. And so when you look at 37% under 12 months, the punchline is that $7.4 trillion in treasuries are going to mature in the next 12 months. And in theory, if there's growth, why do you need safety if there's growth? Obviously, we've touched on the balance sheet constraints that exist globally. And my point was just one of three things is going to happen with this huge bolus of treasury issuance that needs to be rolled, 7.4 trillion in the next 12 months, which is either the U.S. is going to default. That's not going to happen. Or the U.S. is going to crowd out global dollar markets. In other words, they're going to place this 7.4 trillion to the detriment of other dollar borrowers, other dollar refinancers, driving up borrowing costs for them around the world. We've seen this play out a couple different times. That's been bad news for pretty much everything but the dollar. Or the Fed's going to expand their balance sheet, or their proxy, the U.S. banking system, will continue their rapid growth of treasury purchases, and effectively the money will get printed. And my view is that's the case. But it's just fascinating to me that in the narrative that has shifted to that we are back to growth very soon and normalization, they're not talking about what has happened with the fiscal balance sheet and as a result of COVID and how that is going to play in. So I am left scratching my head somewhat that gold is falling as fast as it has been, given what looks very likely needs to happen to the Fed's balance sheet. Next question from Rob: what's the potential downside for gold in this environment? And a follow up to that question from Matt. This is a great question from a macro perspective. What are the chances we're going to see 2013 2.0? It is really a bit of a puzzle at the moment, because you're seeing real interest rates at the 10-year fall. Notably, we saw real rates backing up right from August through about 2-3 weeks ago. That makes sense. Gold should sell off when real rates bottom and start rising. We're seeing real rates get more negative over the last 2 to 3 weeks, and gold hasn't responded. So I'm scratching my head a little bit. To me, it may suggest the falling gold price may suggest insufficient U.S. dollar liquidity, and gold being the leading indicator, the pivot. In other words, gold's falling now, and in the next couple of weeks, we'll see stocks, gold, or oil, commodities, etc., follow if gold doesn't turn around. I think that that's a very plausible explanation. In terms of what are the chances that to seeing 2013 2.0, which is a reference to what happened to gold prices in early 2013. I guess it was really second quarter 2013. You had a 7 sigma move down, so gold fell from probably 1600 to 1300 or 1200 in the span of 4 or 5 trading days. It was just absolutely crushed. To me, it's always possible. It's entirely possible. What's the potential downside? You're dealing with a derivative market. I mean, you have to be cognizant of when you remove the collateral from the gold market. There's really no limit to the downside. That said, I don't think another 2013 is likely this time, and the reason I think that is the things that are very different now versus then. The biggest of these is that you have multi-currency pricing of commodities that is now engaged. Oil is being the marginal oil barrel is being priced in yuan, in euros. You're seeing central banks that are have been buying gold over the last 7 years. That was not the case up to that point in any real way. And when you've got this happening, what's effectively happening is the reference point of commodities gets shifted from dollars to gold. And so the point is that you basically, there has been a process via multi-currency energy pricing, commodity pricing more broadly, where you're beginning to reconnect commodities to gold. Long-winded way of saying, unlike in 2013, if gold goes down, oil's going to go down. And if oil goes down, you can sort of put a bullet in U.S. oil shale, given the depletion rates there. That then has implications, geopolitical, etc. And bigger picture, I think gold going down has is an indication really of not enough liquidity, maybe more than anything else. From OD, significance of Chinese banks suspending new accounts for purchasing precious metals. They appear to be preparing for volatility. The $64,000 question, in my view, is why? Are they preparing for a 2013? Now, I sort of elaborated before that there's no limit to the downside for gold. And what I mean by that is gold could go to zero, the price you see on your screens. Here's how. If there are in London, call it 100 ounces of unallocated claims, paper claims for every physical ounce that exists. Once that physical ounce is claimed, if the market breaks, basically if there's a run on physical gold, which is what happened in 2013, you would expect that to be really good for gold's price. But it's not. It's bad for the paper price. The price crashes. We saw this again in March of this year. If you remember, we had this big crisis. There was with COVID, the price of gold crashed from whatever 1650 to 1450 in a very short order. Now, remember, at that point, we all of a sudden saw these spreads in physical gold blow out to record levels, $100 plus spreads. That's what I would think would conceivably happen. So that's why I sort of put an asterisk and have sort of mumbled my way around this. What's the downside in gold? The downside in gold, gold, paper gold, is theoretically zero, because once somebody owns the one physical ounce, once they've removed that out of custody, the other 99 ounces have nothing backing them except paper promises, no physical gold. In reality, that's not how the world works. It's not how the world was going to work. But to me, it highlights why it's so important to own physical gold, not own paper claims, because ultimately, uh, you would see a separation if there was a run on physical gold. You would, or excuse me, a run on physical gold. You would see a separation in the price. Probably it wouldn't take too long between the price you see on your screen and the physical premiums like we saw back in March. So I don't mean to be sort of mumble or wishy-washy in my description here, but I think it's very important um, to understand that I don't think there's a lot of downside for physical gold. And I don't, and ultimately the prices would true up. But I think it's important to understand that if you, the paper proxies we see on our screens, as we saw in 2013, and as we saw earlier this year, um, could fall pretty significantly for a brief period of time. Now, this ties back to my prior point of as central banks have basically retied gold back to commodities through multi-currency energy pricing that we've talked about. That means and this is something I've tweeted about a number of times, is basically, everyone laughs as gold goes down, all those gold bugs. It's all fun and games until it turns around and the oil market loses an eye, because again, they have retied those two things. So again, I think that's when we say what is China, why is China restricting new accounts in gold and silver? They appear to be preparing for volatility. I just don't know why, but I think it's a very interesting development. Let's see, from Claude, how do you see the chances of a deflationary bust driven by corporate debt defaults in 2021? Uh, Consensus at this point, obviously, given what spreads are doing, is a very low chance. And I would probably say that is correct. I would probably agree with that consensus of what is being priced by spreads at this point. Um, it ties in to as well that what spreads are telling us is, hey, we have a vaccine, we're all going to go back to normal. I'm not convinced that's the case. I suspect there'll be winners and losers. I think if you are systemically important in any way, you will get a bailout, and if you're not, you may actually be allowed to default. And so that is how I would think about corporate credits at this point. Ultimately, I do think if I do think you have sort of this implicit Fed backstop, as intellectually offensive as that is, this implicit central bank backstop. They have committed to keeping markets functioning. And I think that's a key to. We wrote earlier to our subscribers earlier this year that the Fed now has a third mandate. It's unemployment, it's inflation, and it's keeping debt markets functional. So and functional is keeping rates at politically expedient level, keeping spreads at politically expedient level. So I think ultimately this new functional mandate is here to stay. And so I see a very low chance of a deflationary bust in corporate debt defaults resulting. And then last question for tonight from Mia, your thoughts on what's currently happening with gold. We talked a bit about that, but then thoughts on rotation of gold owners into Bitcoin ownership. Clearly, I think there is, without a doubt, a rotation we're seeing out of Bitcoin, or excuse me, out of gold to Bitcoin. Uh, I think that's largely happening at a retail and sort of retail and smaller institutional level. And I do not think it is happening or will happen at what FOFOA called at the giants and super giants level. In other words, it's one thing if we see retail and institutional investors, some smaller institutional investors, putting some money into Bitcoin that might otherwise go into gold. My view on that would probably change. I think it's bullish Bitcoin. I think that probably continues. I don't think it's necessarily bad for gold. I mean, I guess it is losing share on some level. Where I would start to get concerned about gold, though, is if I saw Russia, China, or Saudi Arabia dumping gold to go into Bitcoin. That for me is when you see those are what I would call giants, super giants. So if you see Putin be dumping gold for Bitcoin, that changes the dynamic. Ultimately, something I think a lot of Bitcoiners are missing is, and again, I like Bitcoin, so please don't troll me. But something I think a lot of Bitcoiners, the Bitcoin maximalists in particular, are missing is that energy gets the last word. Oil gets the last word, and by that I mean, um, if Saudi or Russia or both, or they got together with China, or China said this and said, "Listen, we now value physical gold at 1,000 barrels per ounce of 1,000 barrels of oil per ounce of gold." That would be the new market. And so, to me, I think it's really important to watch what's happening with the balance sheets of these super giants when we're having this discussion of, is Bitcoin winning, is gold winning, is Bitcoin going to eat gold? Yeah, at retail, it is eating gold right now. But is it going to eat it at the super sovereign level, at the sovereign level? Bitcoin has an energy debt, and I think that's another important thing. If you're a sovereign, it's important to understand that if you shut the miners off for Bitcoin, that changes the dynamics. You have to keep Bitcoin needs in ongoing energy inputs to function. Gold doesn't. If you shut the gold miners off, the gold pile that you have sitting in your vault is still your gold pile. So, and I think that is something at a super sovereign level, at this giant level, that they think about and understand and focus on. So, at any rate, hope that helps. As always, check out what we're up to on FFTT-LLC.com if you're interested in finding out what we've been up to recently. If you like these updates, check out FFTT Tree Rings, a 10 most interesting things piece that we put out every Friday with some analytics, analysis and write-ups in terms of some current events and signposts we're seeing in terms of things as they occur and as they change. And that seems to be a lot of things these days. So everybody have a great rest of your week. Thank you for joining me tonight, and we will talk with you soon. Take care, everybody.